Okay, so hello, Assalamu alaikum students. This is your teacher again, Azka, but I teach business and accounting to O and A level students. Okay, so this is A levels paper 4 accounting, and this is latest paper as you can see. This is May June 2024 paper 1, sorry, paper 4 variant 1, and we have 1 hour to complete the whole paper. So we have the source A in unzert, and after that we have the source B for question number 2, and here we have the question paper and we have to solve certain questions, but before that we have to read the source. Okay, so in the first question we have to calculate the selling price of 1 unit of product A. Okay, so for finding out the selling price of 1 unit of product A, we have to first of all calculate the total cost for product A, material cost per unit, direct labor cost, overheads, and some other things like other overheads. Okay, so first of all, let's see its cost. Okay, so WJPLC use activity-based costing. It calculates selling prices by adding a markup of 50% to the total budgeted direct cost and the overheads of each product. So following information is available. Each year, the company manufacturer sells 200 number of units of product A and 480 units of product B. And information about the budget direct cost product A is as follows. So we have the direct material cost for per annum, which is $28,000, and it is using 7 kilos per unit. And in direct labor, we require 9 hours per unit, and we pay $11 per hour to the laborers. And we have the budgeted overheads per annum for the both products are as follows. For so quality inspection, so 180 inspections for product A and 320 for product B, and its cost is $12,000. And for order processing, 240 orders for product A and 120 for product B, and the payment we are paying, which is $18,000. Other overheads, which is 37,400, a portion on the basis of units produced. Okay. So now just solve the question. First, we have to find out the selling price. Okay, so first of all, let's calculate the direct cost. So direct material cost. From direct cost, we have the first of all direct material cost. So total direct material cost for per year is for product A, which is $28,000, and the total numbers we produce is which is 200 number of units, and the material cost per unit would be $28,000 divided by 20. So we have the $140 per unit material cost. Okay, so first of all, write the direct material cost, which is $140 per unit. Okay, and now let's calculate the direct labor cost. So the labors required per unit was equal to 9 hours, and labor cost per hour was $11. So labor cost per unit was 9 hours, and the labor cost per hour was 11. So 9 multiply 11, so $99 per unit. Okay, and now we are going to calculate the overheads. So overheads are apportioned based on the activity. So we will break down the overheads for product A. So now let's break down the overheads. So for quality inspection, total inspection for product A was 180, and the total inspection for both products was um, total inspection for both products was equal to 180 plus 320 is equal to 500 inspections. And overhead for quality expansions cost was $1,200, $12,000. And cost per inspection, cost per inspection is equal to $12,000 divided by 500 is equal to $24 per inspection. And quality inspection overhead for product A would be 180 multiplied by 24 is equal to $4,320. So this is quality inspection overhead. Okay. And now let's talk about the order processing. So total orders for product A was total orders for product A was 240, and total orders for both products was 240 plus 120 is equal to 360 orders. Also, overhead for order processing is equal to $1,800. So cost per order would be divided by 360, the total number of orders. So it means that $50 was the overhead for per order. So overhead processing overheads for product A would be 240 orders multiply $50 is equal to $1,200, $12,000. Okay, and let's talk about the other overheads. So total units which was produced 200, and for product A that was 480, and this would give you the total number of units which is 680 units, and overhead for other expenses which is 37,400. Cost per unit for other overheads is equal to 37,400 divided by 680, and this is equal to $55 per unit. And other overheads for product A would be, because its number of units was 200, 200 number of units multiply 55 is equal to 11,000 number of units. Okay, so now let's do step 3, in which we have to calculate the total cost per unit for product A. So this is now the already written here. Okay, so we have written the direct material cost, which is $140 per unit for product A. Direct labor is 99. Quality inspection overhead per unit is okay. So I've written the total, and that was 21.60. And order processing overheads, this is $60. I've written the total, $60, and other overheads per unit. Other overheads per unit is equal to $55. So it means that total cost would be 375.60. So now in step 4, we have to apply the markup. So markup was 50% of the total cost. So it means that markup per unit would be 375 multiply 50%. And this is 187.80. And in step 5, we have to calculate the selling price now. So selling price per unit is equal to total cost per unit plus markup selling price per unit. So it means that to finding out the selling price, what we have to do, we have to add the total cost with the markup. So 375.60 plus 187.80, and this is equal to 563 dollar 0.40. This is the selling price of product A. Okay, so we have done with this information, this question. Now let's see the other question. So we have some additional information, and what we have to do, we have to calculate the change in selling price of one unit of product A, which would arise if option A was implemented. Okay, so now let's see that what type of option one we have. So directors are considering ways in which to reduce the cost incurred by product A so that its selling price can be reduced. So they are considering two options. Option A is the directors think that the number of orders processed for product A could be reduced by 50% if the larger quantity of material was bought with each other. Okay, each order. And discounts could then be earned, reducing the direct material price by 10%. And the reduction in the number of orders processed would also mean that the junior purchasing clerk could be made redundant, and this would reduce the total cost of order processing by 4,944 per annum. And they say that under both options, the rate of markup would be unchanged, and there would be no change to the number of orders processed or inspection undertaken for product B, and overheads would be apportioned in the line with the revised level of each activity. And we have to calculate the change in selling price of one unit of product A, which would arise if option one was implemented. Okay, so basically to calculate the change in the selling price of one unit of product A under option one, we need to adjust the direct material cost and the order processing overhead based on the provided information. So first of all, in step one, what we have to do, first of all, we are going to see the impact of option one on direct material cost. So original cost direct material per unit was $140 from previous calculations, and discount on direct material cost is equal to 10%. And new direct material cost would be $140 multiply 1 minus 0.10 is equal to $126 per unit. And now let's see the step two. So in step two, we are going to see the impact of option one on order processing cost. So number of orders processed for product A will be reduced by 50%. So original numbers of order was 240 from previous data, and the now new numbers of orders is equal to 240 multiply 0.50 is equal to 120 orders. Now calculate new order processing overheads. So original order processing cost per order was $50 from previous data. Now new total number of orders for both products is equal to 120 for product A plus 120 for product B, and this is equal to 240 orders. And original total overheads for order processing was $18,000. So the order processing overhead is reduced by order processing is reduced by 4944 due to redundancy of the purchasing clerk. So then new order processing overhead would be is equal to new order processing overhead is equal to 18,000 minus 4944 is equal to 13056, and new cost per order would be new cost per order would be 13,056 and divided by 240 orders, and this is equal to 54.40 per order. Okay, and new order processing overhead for product A, new order processing overhead for product A is equal to 120 orders multiply 54, which we just find it out, and this is equal to 6,528 dollars. Okay, and in now in step 3 we are I'm going to adjust other cost. So there basically there is no changes are mentioned for labor, other overheads or inspection, so the remaining cost will be stay the same. Okay, so it means that direct labor cost per unit is not changed. Direct labor cost was equal to $99, which is no change. Quality inspection overhead per unit is equal to 4320 divided by 200 number of units is equal to 21.60. So there is no change. And other overheads per unit is equal to 11,000 divided by 200 is equal to $55. So there is also no change. So in next step, we are going to recalculate total cost per unit of product A under option 1. Okay, so the direct material cost per unit is equal to $126. Direct labor cost, which is $99. Quality inspection overhead, overhead per unit, which is 21.60. Order processing overhead, which is 32.64. Order processing overhead per unit 6,528 divided by 200 is equal to 32.64. Yes. And other overhead per unit is equal to $55. So thus the total cost per unit would be $334.24. And in step 5, the markup is 50%, which we have to add. So 334.24 multiply 50%. So this is equal to 167.12. So now the new selling price would be 334.24 plus 167.12. So the new selling price would be equal to 501.36. Okay. So now let's see the other question. So we have to advise the directors whether or not they should implement either option 1 or 2. Justify your answer. So just read the option 2 by yourself, but I'm going to just give you some of the points about this question. So to advise the directors on whether they should implement option 1 or option 2, let's like compromise both options in terms of their impact on cost of patients and potential risk. So the decision should consider both the financial outcomes and the operational implications. So for option 1, because they are going to reduce the number of orders of material discount. So the first benefit would be that there is a direct uh, material cost saving. So it means that the material cost per unit decreased by 10%, reducing from 140 to $126 per unit. And there is one more important thing, which is order processing cost reduction. So the number of orders for product A is reduced by 50%, which lowers the order processing cost per unit. And the total cost reduction, the total cost per unit decreases from 375.60 to 334.25, which leads to a reduction in the selling price by 62.04, making the new selling price, which is 501. So, and there is a key risk also, like there would be a problem of inventory management. So, ordering larger quantities means that a company will have to manage and store more materials, which could increase the storage cost or result in the wastage of materials become obsolete or deteriorate. And there is also one more drawback of using option 1, that there will be dependence on suppliers. So, a large, less frequent ordering schedule may put more pressure on suppliers to deliver large shipments on time, so which could create supply chain risk. And if you talk about option 2, so you can just read the option 2, and you can after that you can maybe listen what I'm saying. So the benefit of using the option 2, that there would be labor cost saving, because labor cost per hour would decrease by 2.30, which would reduce the labor cost per unit, and there's a total cost reduction also. So total labor cost per unit would drop due to the lower wage, but it would be partially offset by the increased production time, 10% longer per unit. And there is also key risk and drawbacks, like there would be increased production time. It will allow less skilled workers to take 10% longer per unit, would slow down production, which could reduce overall efficiency and the company's ability to meet the demand. And there is also one more, is that there would be increase in the quality inspection, because with the 80 additional quality inspection required each year, there's a higher likelihood of production or errors or defects or rework, which maybe would increase overhead related to quality control by $3,080 per annum. This cost could negate some of the labor savings. So these are the, so in recommendation, I would say that based on our analysis, the director should implement option 1 and reject option 2. So why we select the option 1? So option 1 offers a clear reduction in cost and selling price, making product A more competitive while maintaining the production quality and efficiency. So the risks related to inventory management and supplier coordination are manageable. and we should reject the option 2 because it presents more risk, particularly regarding quality and production efficiency, and may ultimately result in higher operational costs due to increased inspection and the longer production times. So that's why option 1 is the better choice for achieving cost reduction without compromising the product's quality or production efficiency. Okay, so now let's see the other question. So we have to suggest two reasons why directors had chosen to use activity-based costing rather than traditional costing methods in setting the selling price. So there is a one reason that there would be this is like more accurate cost allocation. So ABC assigns overhead based on actual activities that drive costs, such as quality inspection, order processing, and production. So this leads to more accurate reflection of true costs associated with each product, especially when the company produces multiple products like product A and product B. So with the varying resources demand, the traditional costing often allocates overheads based on a single factor like labor hours or machine hours, which can result in less precise cost allocation and potentially inaccurate pricing. And the number two reason would be the better decision making for cost control by using ABC, the directors can identify the specific activities that contribute the most to overhead costs and target them for most reduction. So for instance, they can see how much each order or inspection contributes to the overall cost and helping them make informed decisions on how to improve efficiency, as we seen with the options to reduce order processing or adjust quality inspections. So traditional costing methods don't provide this level of a detail, making it harder to pinpoint cost saving quantities, opportunities. Okay, so now let's see the other question. Okay, so we have the question number 2. So before reaching to question number 2, we have to read the source. So the source is that for question number 2, P Limited manufactures a product X and operates a system of standard costing. So budgeted production and sales of product S is 11,000 units per month, and its standard data per unit product X was as follows. Its selling price is this, direct material is this, direct labor is this. And when the actual results of for April 2024 were now the following variances were calculated. So sales price variance was adverse and sales volume was nil. Material price was favorable. Material usage is also favorable. Labor rate was nil and labor efficiency was adverse. So now what we have to do. Okay, so in the very first question, we have to calculate the actual unit selling price. So to calculate the actual unit selling price, we need to use the information about the sales price variance. So in step 1, we have to understand the sales price variance. So the sales price variance represents the difference between the standard selling price and the actual selling price for the number of units sold. So variance is adverse, meaning that the actual selling price was lower than the standards. So in the question it is given the sales price variance, which is $55,000 adverse, and standard selling price per unit would be is equal to $210, and budgeted production and sales is equal to 11,000 units. So calculate the total difference in selling price. To calculate total difference selling price, we are going to use this formula: total difference in selling price is equal to 11,000 multiply standard price selling price minus actual selling price. So if you do this, so 11,000 210 minus actual selling price is equal to 55,000 number of units. So now let's solve the actual selling price. So 210 minus actual selling price. So this would be 11,000. 210 minus actual selling price is equal to this is multiply here. So when we shift this to here, so it would be divide. This is equal to 5. So actual selling price is equal to 210 minus 5, and this is equal to 205. So the actual unit selling price is 205. So you can just solve the whole part here. Okay. So now we are going to calculate. So the second part is the unit selling price, which would have given the same actual total contribution into April 2024 as a standard total contribution for the month. Okay. So we are going to calculate the unit selling price that would have given the same actual cost contribution as a standard cost contribution for April 24. So we need to follow some steps again. So first of all, we have to calculate the standard total cost contribution. So the total contribution is the difference between the standard selling price and the standard variable cost. It means a direct material cost and direct labor cost. So we can calculate this on a per unit basis. So then multiply by the budgeted number of units to get the total standard contribution. So standard selling price. First of all, now let's see the direct material cost is equal to 4 kilos multiply $7.60 is equal to $30.40 per unit. And the direct labor cost is equal to 3 yards multiply 10.50, and this is equal to 31.50 per unit. And the total variable cost per unit is equal to 30 0.40, which is material cost, plus 31.50, which is labor cost, and this is equal to 61.90 per unit. And standard contribution per unit would be is equal to standard selling price minus total variable cost, is equal to standard selling price minus total variable cost. So standard price was 210 minus total variable cost, which is calculated, which is 61.90. So it means that your standard contribution is equal to 148.10 per unit. So standard total contribution is equal to 11,000 was the number of units, multiply 148 is the standard contribution per unit, 148.10 is equal to 162,900. So in step 2 we have to calculate the actual variable cost. So we already know the actual variable costs are affected by the material and labor variances. So let's calculate the actual variable cost based on these variances. So actual material cost. So material price variance is equal to 4290, which is favorable. Material usage variance which is 8360 favorable. And standard material cost is equal to 11,000 number of units multiply 30.40 is equal to 334,400. And actual material cost is equal to standard cost minus favorable variance. So actual material cost, find out the actual material cost. The actual standard cost was 334,400 minus the favorable variance was 4290, and this is equal to 321,750. So the actual labor cost, now let's find out the actual labor cost. Basically, I am finding out all these questions. Actual quantity, total quantity, quality of direct material, actual price, actual hours used by direct labor, direct labor per unit. So I'm finding this one. Okay. So actual labor cost. So labor efficiency variance was equal to 5760 750 adverse. And standard labor cost, which is equal to 11,000 number of units, multiply 31.50, which was the standard labor cost, and this is equal to 346,500. And there is actual labor cost, standard cost, plus adverse variance. So actual labor cost is equal to 346,500 plus 57,750 is equal to 404250. Okay, and now let's see the actual variable cost per unit. So actual total variable cost per unit is equal to 29.25 and plus 36.75. This labor, so this is equal to $66 per unit. So in step 3 we have to calculate the required selling price for the same contribution. So now we need to determine the selling price that would have resulted in the same total contribution as a standard. Okay, so actual contribution per unit would be actual contribution per unit. So to match the standard total contribution of 1629 100, we need to figure out the required contribution per unit. The actual number of units sold was the same as budgeted, which is 11,000 number of units. So required contribution per unit is equal to 1629 100 divided by 11,000 is equal to 148.10 per unit. So the required selling price, we now need to add the required contribution per unit to the actual variable cost to determine a selling price that would have the resulted in the same contribution. So required selling price is equal to actual variable cost per unit plus required contribution. Plus required contribution per unit. So required selling price is equal to 66 plus 148.10 is equal to 214.10 per unit. So the unit selling price that would have given the same total contribution as a standard contribution for April 2024 is $214 per unit. Okay. Now we are going to see the other question. So we are going to see the actual quantity of direct material used in kilos. Okay, so first of all, we understand the to calculate the actual quantity of direct material used in kilos, we need to use the information about the material usage variance. So understand the material usage variance is crucial. So material usage variance reflects the difference between the standard quantity of material that should have been used and actual quantity used, and the variance is favorable, meaning less material was used than expected. So material usage variance was 8360, which was favorable. Standard material cost per kilo was 7.60. Budget production was 11,000 units, and standard quantity of material per unit was 4 kilos per unit. So now we are going to calculate the standard quantity of material. So standard quantity of material is the amount of materials that should have been used for actual production of 11,000 units based on the standard usage rate. So the standard quantity of materials standard quantity of materials is equal to 11,000 number of units multiply 4 kilos per unit is equal to 44,000 kilos. And now in step 3, we use the material usage variance formula, and the formula is material usage variance is equal to standard quantity minus actual quantity multiply standard cost per kilo. So 8360 was the material usage variance is equal to standard quantity was 44,000 minus actual quantity we don't know, we are going to find it out, multiply standard cost per kilo is 7.60. So 44,000 minus actual quantity is equal to 8360 divided by 7.60 is equal to 11,000 kilos. And actual quantity is equal to 44,000 minus 11,000 is equal to 4 to 900 kilos. So this is our answer. So in conclusion, the actual total quantity of direct material used is 42,900 kilos. Okay, and now we are going to see the question number 4, the actual price paid per kilo of direct material. So to calculate the actual total quantity of direct material used in kilos, we will use the material usage variance formula. So in step one, what is the usage variance? It reflects the difference between the standard quantity of materials that should have been used for the production and the actual quantity used. So we have all the information. We have material usage variance, which is 8360 favorable. You can go and check insert. Standard cost of direct material per kilo is 7.60. Budget production is equal to 11,000. Standard quantity of material per unit is 4 kilos per unit. So first of all, we are going to calculate the standard quantity of materials. So the standard quantity of material is the quantity that should have been used for producing 11,000 number of units based on the standard rate of 4 kilos per unit. So standard quantity of material is equal to 11,000 multiply 4, and this is equal to 44,000 kilos. And in step 3, we are going to use a material usage variance formula. So material usage variance formula is material usage variance is equal to standard quantity minus actual quantity multiply standard cost per kilo So the material usage variance is 11,000, sorry, 8,360 is equal to 44,000 minus actual quantity multiply 7.60. To solve for the actual quantity, um, so for actual quantity, yes, 44,000 minus actual quantity is equal to 8,360 divided by 7.60 is equal to 11,000 kilos. Now, actual quantity is equal to 44,000 minus 11 is equal to 4290 kilos. So the actual total quantity of the direct material used in, yeah, direct material used is 40,900 kilos. Okay, so now we are going to see the other question. We are going to see. Okay, so we are going to see the actual hours used by direct labor per unit. Uh, okay, so to calculate, let's see one second. Yeah. So to calculate the actual price paid per kilo of direct material, we need to use a material price variance formula. So material price variance represents the difference between the standard cost per kilo and the actual price per kilo of material used. So the variance is favorable, meaning the actual price paid was lower than the standard price. So we have to find we are going to use a material price variance formula, and this is material price variance is equal to standard price minus actual price multiply actual quantity. And the material price variance was 4290. You can check insert is equal to 7.60 minus actual price multiply actual quantity is 4 to 900. Okay, so first divide both sides by the equation by 42,900 to isolate the price difference. So 7.60 minus actual price is equal to 4290 divided by 4 to 900 is equal to 0.10. So actual price is equal to 7.60. This is 7.60 minus 0.10 is equal to 7.50. Okay. So now let's see the other question. So name the budget which P Limited would have prepared if actual sales unit had been more or less than the budgeted 11,000 number of units. So if P Limited had prepared a budget to account for actual sales um, unit being different from the budget 11,000 units, they would have prepared a flexible budget. And the next question is that suggest four reasons why the company uses standard cost. So there are four reasons. First would be the cost control. So standard costs allow the company to set benchmarks for cost, for example, direct material and labor, and enabling management to monitor actual performance against these standards. And any significant variances can be identified and addressed, helping the company control costs and improve the operational efficiency. And the number two reason would be the budgeting and the forecasting. So standard costs provide a consistent basis for preparing the budgets and forecasts. They make it easier to estimate costs and profitability for future periods by offering a clear and consistent framework for the expected cost. And number three would be the performance evaluation, because standard costs help evaluate the performance of departments, managers, and employees by comparing the actual cost to the standard cost, and management can assess the efficiency and effectiveness of production and identify areas which we need to improve. And a fourth one would be that this is a simplification of costing, because using standard costing simplifies the process of costing products instead of continuously recalculating costs based on the fluctuating prices and operational changes. So the company can use predetermined standard costs to streamline inventory valuation, pricing, and decision making. And the next question is that P Limited has always prepared all its budgets manually. So directors are now considering the use of spreadsheets in preparing the budgets. Advise the directors whether or not they should use spreadsheets in the preparation of the company's budget. Justify your answer. Okay. So basically, the directors of P Limited should strongly consider using spreadsheet for the preparation of company's budgets, because spreadsheets offer numerous advantage over the manual budgeting, making the budgeting process make more efficient, accurate, and flexible. So first advantage we would have that it would increase accuracy and reduce errors. Manual budgeting is prone to human errors such as miscalculations or data entry mistakes. So spreadsheets like Microsoft Excel can automatically perform complex calculations and significantly reducing the risk of errors. So built-in formulas, data validation, and error checking tools in Spreadsheet help ensure that calculations are accurate and consistent throughout the budgeting process. And the second advantage would be that it is efficient and time saving. So spreadsheets can dramatically speed up the budgeting process once the formulas and the templates are set up. So they can be reused for future budgets, saving time, changes to data or assumptions. So for example, sales volumes or cost rates are updated automatically across the entire budget. So this is especially helpful in large or especially helpful in large complex budgets where manual calculations can be time consuming. But there are some potential drawbacks. So meaning that there would be risk of overlay complex models because spreadsheets can become overly complicated with too many formulas, making them difficult to manage and or audit. So this risk can be mitigated by with the proper structure and the documentation. And there is limited collaboration because spreadsheets are less collaborative compared to the advanced budgeting software that allows multiple users to work simultaneously still with clouds based tools like Google Sheets or Excel online, and this limitation can be reduced. So in conclusion, overall, the advantages of using spreadsheets, including improved accuracy, efficiency, and flexibility and cost effectiveness, make them a strong tool for budget preparation for P-Limited. So given these benefits, directors should move forward with the adopting spreadsheets for the budgeting process while ensuring proper training and model management to avoid the potential pitfalls. So this is it for this paper. So if you have any question, you can just comment in the comment section. And goodbye, Allah Hafiz.